Welcome back, investors, to Ticker Time News. I'm Adam, and traders and portfolio managers alike, they focused on end of September and Q3 tactics, or you could even call it games today. The overall mantra for September has been to sell first, ask questions later, as it yet again earns its historical title as being one of the worst performing months for equities. This is something we shared with our investor community and right here on this channel as we began the month of September. The stock market did have a decent start to the day, but gave way to steady selling pressure that began around 11 a.m. Eastern. Economic slowdown and rate hike concerns weighed on investor sentiment. In addition, market participants were contending with another weak session from Apple, who lost 3% today. An unsettling inventory buildup reported by Dow component Nike, who lost 12.8% today. That was a big drop. And an uptick in the August core PCE price index, which is the Fed's preferred gauge on inflation. Treasury yields started to rise in the afternoon, adding even more fuel to the sell-off in stocks. Now, at least this week, small caps, IWM. Let's pull that up real quick. Ticker symbol is IWM. This is for the small caps like the Russell 2000. You can see this right here. Let me open this chart up just a little bit, bring it up some. I know those candles are getting deep into that volume. All right, look at the IWM. The IWM, which are the small caps. Market can't catch a break. You are exactly right. Let's throw this up on the screen here real quick. No, the market can't catch a break. And unfortunately, there's only two paths for this market to go. And we're going to talk about both of those paths in just a moment. But I want to focus real quick here on small caps because there's something interesting happening right here. Hi, Adam. I made a lot of money today. Woo! Awesome. Awesome. Glad to hear that. Let's throw that up on the screen too. If you were in puts or if you were shorting equities today, you did good, not just today, but you did all week because the market, all of them, the SPY, the Qs, the IWM, were down on the week. But let's focus here on the small caps for just a second, because this is giving me a little bit of hope that maybe as we start October, maybe we can catch a bid. Now, small caps, IWM is the ticker symbol that I use for that. They held up better than their peers, better than the SPY, and better than the Qs, at least in the sense that they have yet to take out their respective June year-to-date lows. Look here on the chart. Let me get my highlighter here to help show what I'm looking at. All right, so the June low is right here. It's this candle here. I know my arrows are hideous. And if you look at where we cut down low this week, it was on September the 26th. We got to a low of 164.17. 164.17. The June low is 163.9. So it's only a few pennies, but still the small caps held their own and did not register a new low for the year, which is a really good thing, right? Let's look at this real quick. I want to focus in on after that low on the 26th, right? The small caps here, you could almost say they are flagging a little bit. I almost see that pattern there for the IWM. And if it's flagging, that's a bear flag right there, which means we're going to take out those June lows shortly. However, since the small caps held their own here, right? While the weight of the broader market can easily drag them down, can easily drag the IWM down with it, we need to recognize their relative strength. Since the 26th, the actual flow here has been ascending. We have not undercut that low from the 26th nor have we undercut the low of the year back in June. So we need to recognize that relative strength there. That could lead to something. The IWM was down 0.7% today versus the SPY's 1.5% loss today. So if there's going to be a relief rally, and there will be at some point, it often is led by those areas that got a head start, not by rallying, but by holding up better and not falling as far as the rest. So that's important to note. Now, the S&P 500, we got to talk about that because it made a mess of its own. Let's go to the SPX, which is the S&P 500. That's the ticker symbol I use when charting and looking. You can also use the SPY. They're relatively the same, except the numbers, right, are a little bit different. Now, let's bring this up here and look, and you can easily see that today we undercut the June low. Very easy to see that. It stands out like a sore thumb on the chart here that we hit a new low today, 35.85. Now, the S&P 500 closing below 3,600, below that 3,600 level, and settled at the new low for 2022, again at 35.85. This opens the door for prices to drop towards 3,500. Why is that number important? That's where this yellow line is sitting right here. Why is 3,500 so important for the S&P 500? Well, if you look at 3,500 and you throw a Fibonacci retracement tool on the screen, and if we tighten this chart up, let's tighten this up, and I'm going to show you right here. Let's get it a little tighter. I need to get to that March 2020 low. All right, there we go. Now, if we get the Fibonacci tool right here, and we go to that March low, which is way down in the weeds, okay? And then we ride this thing all the way up to the, all right, stay with me now. Stay with me. To the January 2022 high, which is about right there. Take a look. Let me get the highlighter back out. I want you to pay close attention to this blue line right here. It matches up with that trend line that I made, and we'll open it up a little bit here so you can see that better. Bear with me while I get this thing open back up so we can have a better look-see here. Almost there. Just got to raise it up just a little bit so it's all on the screen so we can see it. All right, that blue line where I highlighted, it matches up with the yellow line right here. 3,500 on the S&P 500. That is the 50% retracement level off the March 2020 low. That is very significant. If the 3,500 level breaks, and I do believe it will, I don't think it's going to break in the first part of October because I think we're going to catch a bid. But once we get to the middle of October, and I'm going to show you a picture here in just a minute of the historical averages, I think by the time we get to the midterm election, we'll be tapping down here, which is a pretty far leap from even where we are right now. Okay. And just to point out, that fib number right there is just about at a 38.2% retracement. Isn't that incredible to think about that? That 2022 is sending us halfway down to the lows that we made in March of 2020, in the thick of the beginning of the pandemic. Now, although there are a lot of extremes in this market right now, and it's leaving the market in an oversold condition that could easily create the possibility of a relief rally developing very soon, perhaps catching a bid in equities to kick off in early October. Historically, and let me pull that picture up I was talking about. Here it is. Historically, that has been the case. Look here on this chart. Let me see if I can't get some drawing tools for this chart. Maybe. Is this going to work? I haven't tried it on a live stream yet, but maybe this will work. And let me get my blue color here. Okay, let's draw a couple of lines on here. Let's make it kind of as big as we can. This line right here, okay, this separates August, the end of August, the beginning of September. This line right here separates the end of September and the beginning of October. Now, with all of these squiggly lines on here, the one that I want you to pay attention to the most is the red line, okay? The red line represents the S&P 500 midterm election year seasonal pattern going all the way back to 1946. So this red line is historically how the market moves when we are in this type of a midterm election season. So even though we may catch a bid in early October, we would not be out of the storm just yet, because there would be another major fall taking out the low of the year leading up to the midterm elections. But after the election is over, at least historically, equities catch a bid to close out the year. Now, some may say this is not a typical midterm election year, and I have to agree. With the Fed raising rates and tightening as quickly as it is into a slowing economy, that is not a great recipe for success. Now, the red line here, if you notice, okay, this, going back to June, all right, this box right here, okay, this would be June. And if you notice, there's a low for the year right there in June. But if we come on over to September, and the September box obviously is this box right here, there is a low right nearly at the same level as the June low. Now, we know by looking at the chart today, we took out that June low. We actually did it a couple times this week, but today was the big takeout of that low. Now, if we look historically, what happens, the beginning of October, okay, we typically catch a bid in rally. But then about halfway through October, we reach that high and then we drop, setting a new low for the year, right as the midterm elections are taking place. Then, after the elections are over and all of the FUD that is created during the month of October, leading up to the election, after that FUD has been washed out, then we typically see a rally into the close of the year. Is this year going to play out like history has showed us that it could? There's a good possibility that we follow a very similar path, because we have already. I mean, the summer rally is right here. In the summer rally, it took place on the chart right here, okay? Oh, my circles are getting a little bit out of place, but that summer rally took place right here, just like it did on the historical chart for the pattern. So we have this to look at. We also have our current chart to look at. So saying that we could catch a bid from where we are now is very, very likely. I'm just trying to clean up the chart here a little bit. Okay. Yes, very interesting indeed. I do find it fascinating. That's why I dug into this, and I am fascinated at it as well. So what does that say for us going forward? Well, it says that we should be catching a bid, meaning we should see somewhat of a rally. It's not going to be a big one, but it will be big enough that it may draw some investors back in. Like, we could go down from here. We could tap that 3,500 mark on the chart and catch that 50% retracement. And then we could catch our bid going into the middle of October. And then that's when we catch our low going into the midterm elections, tagging my box that has been down here since nearly the beginning of the year. You can go back months and check out any live stream, and this box has been here. It has not been moved. This is what my thesis is telling me, that the market, yeah, we're going to catch a bid in early October, but sometime in the middle of October, we're going to come back down. We're going to undercut the low that we just made this week, and maybe a low that we'll catch next week. And then we'll go down for a final low for 2022. And then we could rally out of that into the end of the year. Now, doing so, if I tighten this chart up and things kind of work out in this way, let me show you this real quick. I just want to get 2022 on the screen here, and I want to show you this. And then we're going to talk about a little more about what happened today in the market after I get this done. I don't want to go up too high. I got to squeeze this together just a little bit just to get this just right, because I want to show you the importance of this playing out. Okay. So let me get my highlighter back. Now, when we started the year 2022 in January, we made our high, right? Well, we made a lower low, we made a lower high, made a lower low, we made a lower low, we made a lower high. And if this continues, we made a lower low today, maybe even a little bit lower going to 3,500 next week or so. And then we make a lower high, we make a lower low, and then we end December making a lower high for the year. And then what does 2023 bring us? Who knows? That's up in the air for right now. We are just starting the fourth quarter of this year. We still have Q3 earnings to go through later on this year. So the last 3 months of this year are going to be packed with a ton of action and a ton of things to go right and a ton of things to go wrong. But the lower highs and lower lows will probably finish out 2022 with it being a negative year on the books. At least that's what it's looking like right now. You tell me if you think it looks any different than that, and we can chat about it. Now, I'm not saying that what I believe is going to come 100% true. I do not get everything right, okay? Earlier this week on Monday or Tuesday, I can't remember which day it was, I thought we could drift higher this week because I thought the market was reaching extreme oversold conditions. It was. But now we've reached an even extremer oversold condition than we were at the beginning of this week. And if we sink any next week, boy, oh boy, is that going to put us in a really, really deep oversold market. And when the market gets oversold, value just happens to pop up, and investors, especially traders, take advantage of those lows. So that is what could cause us to catch a bid sometime next week and let us rally into the middle of October. All right, there's what I think for the market for the rest of this year. Doesn't look pretty, but at least I have it mapped out as a plan. So we know how to set up our trades and what to look for going forward. That's what this overview was. So we could get a game plan for the last quarter of 2022 and figure out where do we think the market's going so we can plan our trades for that. Whether we're shorting, whether we're going long, looking for a bounce from oversold conditions, it'll all play out eventually, right? Okay, let's talk about a couple of interesting things that happened in the market today. NKE is the ticker symbol for Nike. Nike did not do good today. It reported a huge inventory increase of over 44% year over year, and gross margin pressure for its fiscal Q1, and it also warned of continued gross margin pressure for fiscal Q2. This stoked slowdown concerns, while a year-over-year increase in the August core PCE price index, which we'll talk about in a little bit in greater detail, but that went from 4.7% up to 4.9%. And that's showing that inflation went up with all the tightening the Fed is doing, with all the rate hikes the Fed is doing. It takes time for those things to work. And with inflation going up, with the core PCE, which is the Fed's primary tool for looking at inflation, the Fed, people are worried about the Fed tightening, continuing to hike rates with a very unfavorable monetary policy towards the stock market. Doesn't look good. With inflation still going up, with core PCE, that says the Fed will continue to hike rates. 75 basis points is so far the consensus member meeting. They do not oh, did I just have a little glitch? It should be coming back any moment. Bear with me. Hold with me. There we go. It's back on the screen. Oh, no more like that. Don't do that again. Okay, so Nike 12.8% drop today. Core PCE going up with inflation. The Fed will continue its rate hiking, and we can actually go over here. Let's do this real quick. Okay. CME Fed Watch Tool. Bam. Type it into Google. First link that pops up is typically it. It's cmegroup.com, and that will take you directly to the CME Fed Watch tool. Now, this is basically a consensus of where the market thinks the Fed is going to go with its rate hikes, meeting over meeting over meeting. Let this thing load. Takes a little minute. Takes a second. We'll get it. Yes, we're back. Hopefully no more glitches like that. My fingers crossed. Yesterday was a disaster. Okay, this is the November 2nd. It begins on the 1st, ends on the 2nd. So November 2nd, we will get another rate hike decision by the Fed. And here's what the market is pricing in right now. The market is pricing in a 58.9% probability of a 75 basis point rate hike and a 41.1% probability of a 50 basis point rate hike. That's what the market is expecting. The probability. If we go to December, let's look at December right quick. With that load. There it is, middle of the screen. 62.8 or 62.6%. I can't see. My eyes are getting so fuzzy here. 62.6% probability of another 75 basis point rate hike at their December meeting, which is December 13th and 14th. So the market expects another 75 basis point rate hike in November and 75 basis point rate hike in December. That's just going to cause the market to go all haywire unless it gets priced in earlier, right? And then the market would expect the 75 basis point rate hike and not be affected nearly as bad as it has been, right? The market with the summer rally was front running a Fed pivot. But now the market knows the Fed is not going to pivot and the Fed is no longer your friend. And that stuff is getting priced in. But we also have an earnings recession to watch out for in 2023. That is going to cause a whole bunch of problems in the market that haven't even begun to be priced into this market. So we have to be careful for that in 2023, Q1, Q2, most likely. When fourth quarter of 2022 results are out there for earnings season, that's probably when earnings recession is going to kick in hard. All right, let's go. 10-year yield today. We can look at that US 10Y for the 10-year. It was at 3.7% earlier, and then it settled the session up 4 basis points to 3.79%. Now, we did get a cooling off in the 10-year and 2-year this week, which was a good thing, right? What was happening across the pond in England, that was really the biggest driver here for the pullback in treasuries. The treasury market, the currency market, they were going haywire this week because of that. So we did have a nice pullback here. However, to me, that pullback was incoming. We knew we were going to have it because it had gotten off of its trend line above that 5-day EMA, which is like the electrical circuit that the candlesticks must be plugged into in order for it to properly operate. It just pulled back to its trend. Now, the 2-year US 02Y on TradingView, and there is a link in the description to TradingView. You can sign up, doesn't cost a penny, and you can chart along with us at home. Now, the 2-year was at 4.13% earlier in the day, but it settled the session up 3 basis points at 4.20%. Yes, at 420. That's where it closed today. Up a little bit in after hours, but that's okay. Same thing here with the 2-year. It got disconnected from its 5-day EMA, and we needed that pullback to reconnect with it, and now it is firmly connected to that 5-day EMA. So it is still on its uptrend. Now, what I'm expecting here for both the 10 and 2 is for it to consolidate here at least for a little while. Okay. Typically, the cycle of the market is we get expansion, and then we'll get a period of contraction, and then we'll get expansion, which leads again to contraction, which will eventually lead to expansion. Okay. So that cycle is firmly in the market. It happens with equities. It happens in treasuries. It happens with currencies. Expansion leads to contraction, leads to expansion, leads to contraction, and on and on and on that cycle goes. Sometimes it'll skip one, and when that happens, that's when you get to extreme levels. So we're in a bit of a contraction period right now with the main indices. Now, the upward drift in the treasury yields and the losses in the mega cap stocks, especially Apple, AAPL, Apple was hit hard this week, and it weighed down index level performance as the session progressed today. Now, the Vanguard Mega Cap Growth ETF, ticker symbol MGK, it closed down 1.8% versus a 1.1% loss in the Invesco S&P 500 equal weight, and then the 1.5% loss in the S&P 500. But look at Apple. It completely fell through its weekly expected move, which was sitting at 143 right here, It fell through it yesterday, and today it just continued to fall to 138.2, down 3%. Isn't that something? Let's go to the weekly view here for Apple. Let me click a button here to clean this candlestick mess up. There we go. And you can see Apple for the week, it just, man, it fell hard. 8.13% for the week. And look at this. Since reaching its head and shoulders pattern right here at the top of this market right here, the summer rally, head and shoulder pattern, it has just been straight down for Apple on the back half here, which is incredible to think. That far down for Apple. But it did it. And there's a lot of concerns about Apple because Apple is in a whole ton of products on the market, a whole bunch of ETFs. It is like one of the star stocks to hold inside of an ETF, especially one with technology focus. And when it falls hard, it pulls the market down with it. Now, speaking about the overall market, let's look at our sectors. 10 of the 11 S&P 500 sectors closed with losses today, ranging from down 0.4%. And you can see on the right-hand side of your screen, these are the 11 sectors all the way to the right, the percentages. That's where they were up or down for the day. And you can see here 0.4% loss for materials, XLB, and a 2% loss for utilities, XLU, and utilities is a very defensive sector. So people were not running to defensive names this week. They were just strictly pulling out of the market. And with utilities being down 2% today, that is proof right there that money was coming out of the equity market. Now, the only sector in the red was real estate, XLRE. Now, it being the lone holdout in positive territory, gaining 1% on the day. Now, there was one other bright spot in the market today besides the real estate sector, which holds a bunch of REITs. Micron, ticker symbol MU. They weren't up big. They were up just 0.2%, and it squeezed out that modest gain after reporting a better than expected fiscal Q4 earnings. But then it also warned of an earnings shortfall for fiscal Q2. Interesting, huh? Earnings revisions are something that we will be seeing a lot of. I mean, you typically see earnings revisions all the time, right? In between earnings, that 3-month period of time, earnings revisions come out for EPS and revenue. They go up, they go down. They fluctuate a lot, just like the market does in price action. But what we haven't seen yet, but we are starting to see, are earnings being taken down. EPS lower, revenue lower, margins being pressured, just like Micron warned, just like Nike warned, just like what's being reported at Apple, right? All right, there's a little bit of the market action today. I want to talk about some data that came out today, okay? So I'm going to go back here to the SPY. I'll put that up on the screen here real quick, and we'll talk about the SPY, the Qs, real quick, because I do want to talk about them. They stayed within their weekly expected moves, which was great. Okay, real quick, economic data. Personal income increased 0.3% month over month in August, right on expectations. That was good. Personal spending, though, rose 0.4% month over month in August, which was double the expectation of only 0.2%. I know it's not real big moves. 0.4%, 0.2%, what's the big deal, right? Well, the takeaway here is that the inflation the Fed says it can control, which is the core inflation, did not move in a friendly direction in August. It went up. The Fed, it's got two mandates: full employment and bringing inflation down to 2% at an average annual rate. If inflation is still going up, with all the tightening the Fed has already done and all the tightening the Fed is planning to do, what do you think the Fed's actually going to do? It's going to put even, a better analogy. I was thinking one, here's a better one. The Fed is going to slam on those brakes, causing the economy to come to a full stop. Full stop. Slamming on the brakes. That's what the Fed's going to do. And that's where something will break, right? You can't just race your car around a track and slam on the brakes over and over and over again and expect those brakes to hold every single time. Eventually, those pads will get worn out. That rotor will get worn out, and then you won't have brakes to stop, and you'll crash into something. That's what the Fed's doing. Okay. All right. So with this, market participants can continue to expect the Fed to not be their friend with monetary policy. All right. Something else we got today. The final September University of Michigan consumer sentiment reading. It came in at 58.6, which was lower than expected. The expectation was 59.5, which that's what it was during the last reading. The key takeaway here is that the decline in consumer sentiment across the income distribution, low to high income, has been consistent for the past 6 months, underscoring the shared concern about inflation pressures, no matter where you fall within the monetary bracket. Now, looking ahead to Monday, there's a couple of things that we need to watch for, and then we'll talk about the SPY and the Q. 9:45 a.m. on Monday morning, market participants will receive the September final IHS market manufacturing PMI reading. The prior reading was 51.8. We got to watch that number, 51.8. 50 is that reading, the line in the sand. If you come in under 50, you are contracting. You're shrinking. Anything over 50 is expansion, okay? So a 51.8, even though it's really, really close to contraction, is still growth. It's very little, but it is still growth. So we got to watch that. Does it come in under 50? Then at 10 a.m. Eastern, we get the September ISM Manufacturing Index. The prior reading was 52.8. And again, the 50 number is the line in the sand between expansion and contraction. If we get 49.9, we are contracting. 50, we're barely expanding. We're basically, 50 is you're not moving, but it's still considered on the growth side. 50.1, you do have a little bit of growth, a tiny, tiny, tiny sliver bit of expansion. But 49.9, you are contracting, even though that would just be a little bit. And then we also, on Monday, get the August construction spending report. The prior reading was a negative 0.4%. I'd imagine that's probably going to still be negative. Going into an economic slowdown, builders aren't excited to build homes, even though we need them to be built. Yeah. Okay. To set you up right here, let me put this up on the screen right quick. Seems like there is more downside coming. Yes, I do believe there is more downside coming, which is exactly why on the SPX, where I do the majority of my charting for the S&P 500. That's why I have this box right here. This red outline box colored in with yellow. Right now, we closed basically right on the weekly expected move for the S&P 500. The weekly expected move on the lower end was 35.68, and we closed at 35.85, so just above it. Now, I do believe we will come down lower, but we are so extremely oversold right now. The SPX on the RSI, which is the relative strength index, is at a, what is this? Where are we? Let me go back here to the daily view so I can get this right. I couldn't quite see the number. Too many wiggly lines in the way. Okay, a 27.1, a 27. 30 and below is oversold territory. Now, when you get oversold, you can stay oversold for a while, okay? It doesn't mean as soon as you reach 30, oh, you bounce right up to 70, going from oversold to overbought. No, you can stay in that oversold condition for a while, which is kind of what we're doing. Let me get my highlighter here. The RSI, which is this box down here, it has been grinding lower, and it reached a low point right here at the beginning of this week, and then it just kind of moved sideways. Now, that could continue for a little while, and then we, at some point, we're going to have to get some sort of a bounce, some sort of a relief rally. Just like the market doesn't go straight up, the market doesn't go straight down. Now, where we are in the market, I would not say let's short this market because we are just too oversold right now, too much in the hole to short. That saying, don't short in the hole, yeah, that's where we are. We are in the hole, and now's not the time to be shorting. You can still look for potential shorting opportunities, but right now, the trend right now is on your side to look for a long opportunity, and not a long-term long opportunity. I'm talking about a simple bounce, right? I said this at the beginning of the live stream. Maybe we do dip down to 3,500 on Monday and Tuesday, and then we finally get a bounce. A bounce is incoming. There's no doubt about it. How much lower we go before that, how much more oversold do we get before that is the big question, and nobody's got a crystal ball to answer that. All right, let's look at the SPY and then the Qs. I want to point a couple things out here for you. Now, this week, the options market got it right, and the options market priced in risk real nicely. If you look, the two purple lines, every Sunday evening, we share with our private investor community weekly expected moves for the upcoming week. And it typically has a 68% win rate. That is really, really good. So here on the lower end of the weekly expected move for the SPY, it was at 355. The SPY closed at 357. That is really good risk. What's the word I'm looking for? Oh, it just left my mind. Okay. Oh my gosh, the word's on the tip of my tongue and I can't think of it. I can't say it. Oh my goodness, it's getting blocked. Okay, let's move on. A good risk reward setup, let's call it that way. The market basically went sideways this week and then down today, but stayed within that risk range. That was what I was looking for. Range, risk range. Now, if we go back and look, let me just clean these Sharpies up real quick. Boom, boom. And let's go to the Qs. The Qs did the same thing. Risk reward, thank you for that. Greatly appreciate it. That's a one way to put it too, risk reward. Okay, let's open this up here a little bit, and I want to show you this. Up we go. Get out of that volume. Okay, so the candle today, right? It did not break the lower end of the weekly expected move. These lines have been here since Sunday evening. Every Sunday evening, we send it out to our private investor community so you know what the risk is for the upcoming week. Now, the lower end of this was 264 for the Qs, and the Qs closed at 267. That is really, really spot on. Now, if we go and let me take these Sharpies off, and we'll go look at the IWM real quick just to point out these moves. The IWM did a little bit different, and I believe we did mention this at the very beginning of the live stream here. Let's open this up a little bit. The IWM, its relative strength compared to the SPY and the Qs held up much better. It did not get down to the lower end of its weekly expected move. Its range was 160 on the bottom, 174 on the upper end. That was the risk range for this week. And again, those lines were up since Sunday evening, and they get updated every Sunday evening. So here we go. It moves sideways. It's really close to flagging, in my opinion. Okay, now that we have gone through all of my notes here, before we wrap up this live stream, now is a great time to ask any question you have. If you have a question, put it into the chat, live chat, and we'll go over it right now. So while you're doing that, though, can I ask a quick favor? Can you click that like button and share this video with a friend? Those two things really help out the channel greatly. And if you like the perspective and you want more of it, join our investor community by clicking the first link in the description. You'll get instant access to our weekly expected moves, numerous trade setups, 16 different trading strategies, top 10 stocks, and 4 different categories like value, growth, dividend, and momentum, economic and market insights, and of course, our private Discord server. Now, we do have public, I forget what they're called now in Discord, public channels on our Discord server. So even if you're not in the investor community, you can still hop in to those channels if you want. And we do all of this to help you along your investor journey, to help you gain the knowledge to become a better investor, a better trader, and reach your financial goals. Okay, that's it. That's everything. All right, so if there's no questions, we will wrap this live stream up for today. I want to thank you so very much for joining me today. It is a great honor to have you here with me. I appreciate each and every one of you for your time here with me. So hopefully you walked away learning something new about the market, about an indice, and you can use that in your own trading plan or investing plan or your market thesis, whatever it is that you do. Okay. All right. You are welcome. Thank you. Thumbs up and cool shades back to you. I greatly appreciate that. As a matter of fact, let's do this so everyone can see those emojis. All right. Thank you so very much for joining me. Have a wonderful weekend. Oh, and our investor community, look out Saturday. Saturday, I have a note going out, a big kind of 30,000 foot view of the market. And then Sunday evening, the weekly expected moves. So be on the watch out for that. Okay, just caught your question here. Let's put it up on the screen so we can all be a part of it. Do you think Monday will bounce? Apple still looking for bottom. Okay. I do not know when exactly we will bounce. I don't know if it'll be Monday, if it'll be Tuesday or Wednesday. What I do know, and I'm very confident about, is we will get a bounce soon. Remember, I don't know if you were with us in the beginning, but historically, and I really should, let's see if I can, historically, October, we get a rally, a S&P 500 on the seasonality going back to 1946. It says that during this type of a mid-year election cycle with a second year new Democrat president in office, we typically see a bounce in a rally at the beginning of October. Then sometime in the middle, it drops and it gets to a new low for the year. Remember, we hit a new low today in the S&P 500. So the end of October, beginning of November, we're supposed to, historically anyways, undercut the September and June low. And on this picture, it shows June and September as the two lowest points of the year. And then it shows the end of October being the lowest point of the year. There is a very, very high likelihood that Apple has not found a bottom, and it's not even close to finding a bottom yet. The overall indices are not at their bottom yet for this year. 3,500 is a target. If 3,500 gets broke, then I believe we are going to 32.75. All the way down here, this yellow box, 32.75. Those are the two important numbers on the chart that we need to pay attention to. Now, we're going to get a bounce. But again, I don't know if it's going to be Monday or Tuesday or Wednesday. I don't know the exact date, but it is going to happen relatively soon. Okay. Sorry, I can't give a more precise answer than that. But if I said, yeah, we're going to see a bounce on Monday, 100%, I don't think I would be doing you any service whatsoever. So I'm just trying to be honest here. I don't know the exact date, but I do know we are at big time, extreme levels of bearishness, of sentiment, price action. It's all there. Extremely oversold. We will see a bounce from this. And then I do believe sometime mid-October, it'll turn around and come back down and will undercut, creating a new low for the year. And then we could see a rally or at least a bid going into the close of the year. So hopefully you found information in this video that is very helpful. I see you there. Monday or Tuesday is your prediction for a bounce. It's coming. It is coming. I just don't know the exact date. Whether, again, I sound like a broken record here. I don't know if it's Monday, Tuesday, Wednesday. Maybe it's not next week at all. Maybe we get some sort of capitulation next week, sending us down to that 3,500 level, and then we bounce from there. So a couple things to watch out for, even on the 15-minute time frame here. For the SPX, which is the S&P 500, load this up. I mean, you can see this week was just chop around, chop around, chop around, create a new low. So from this, we could totally see a bounce on Monday. That is not out of the likelihood. Tuesday even, right? It's just coming soon. Sorry, I couldn't be more precise than that, but I just wanted to be honest with you. All right. You are welcome. You are welcome. If there are no more questions, then I'll go ahead and wrap this up. Maybe give you a second or two if you do have a question that you want to put into the chat. I am happy to answer it for you, or do my best at answering it. And if I don't know something, don't worry. I'll tell you I don't know. I'm not afraid to do that part. Okay, well, if that's it, then I greatly, again, appreciate each and every one of you. Have a awesome weekend. Do awesome things. Have fun. Don't let the market stress you out. You can still make money in a down market. It's not too difficult. Don't worry about the timing of things. Just have your plan. Stick to your plan. Make sure you're using stop losses. Trailing stop losses work great. Keep your risk management tight. Use small position sizes. Don't go out and play your whole portfolio on trying to time the market perfectly. That's when you could end up making mistakes. As risk goes up, your position size should go down. Remember that. All right, investor community, thank you so very much. I appreciate you. And our private investor community, Saturday, there will be a note going out, bird's eye view of the market and what to expect, what I think. And also Sunday evening, the weekly expected moves for the upcoming week. And thank you again. And I'll see you in the next video. Take care.